You've been around this India startup ecosystem for a while now, and certainly Nykaa has a unique place in the ecosystem where you were leading the charge of their IPO. Can we get a masterclass on IPO in India? Are you ready for that?
Yeah, I won't call it a masterclass, but I'm happy to share my learnings for sure.
So let's start with kind of establishing how does a company know it's ready to go public? What are the strategic considerations to think about?
Yeah, let me give a simple framework again, and that comes after reflection after doing Nike IPO. I think there are three things that needs to tick off, and the first thing is market being ready. The second thing is business being ready, and the third thing is your processes being ready, or I call it internal readiness. So the first thing, which is market being ready, is something that you don't control, and since you don't control, you shouldn't overthink about it. There are experts who will advise you what is the right time to go for an IPO, and they're always doing it for their living, right? So banks will advise you, advisors will advise you. So it's not something that you should worry too much. Don't try to time the market. There are experts who will guide you. It's anyway not in your control. The second thing, which is business being ready, is definitely something which is the first important tick that one should think of. What do I mean by business being ready, right? Now, there are companies which have done IPO even when they were they were not making money or they were not profitable, um, and that's okay, so long as you can explain to the investor path to profitability in very succinct and a very uh, clear articulation of which KPI you track and how does it uh, become path to profitable measurement criteria and how do you reach there. But I would still say that if you have a choice, then avoid entering into market before you are profitable. So in my view, let's say Nykaa, for example, uh, and I learned it from Falguni, right? She has been IPO banker for years, and she has seen many hundreds of IPO, maybe 100 IPO plus, right, as investment banker. And she had that very clear thought process that we should be PAT positive before we go IPO, right? And that made sense, right? Because it makes it clearly tells your investor that your unit economics is already proven and it's a profitable business model. It needs capital to grow further and create value, but there's no challenges in terms of business model being proven, right? Nykaa was in EBITDA positive zone for 3 years before IPO and just became PAT positive before IPO. It's a good sign, good place to be in. So the other thing about business being ready, I will tell, okay, unit economics should be proven. You should be ideally seeing first sign of profitability. The other thing is have a clear strategy and not necessarily too many bets which are yet to be proven, right? So if you have four business model, one is proven, three are yet to be proven, it is still, I will say, postpone IPO for a couple of years, uh, right? So because the ability to experiment goes down dramatically once you are a listed company. If you want to experiment, continue to be private, and there is enough private equity available. It's not that capital is a constraint for a private company, right? So one should be very clear. Why do you want to do IPO? The objective of IPO should be very clear, right? So it could be raising of capital, but then capital is available in private side also. The other could be that you want to create a brand which attracts talent, which attracts other business partners. That's a valid purpose. The third could be that you want to build a positive performance pressure, right? You invite performance pressure. Once you are listed, you will be judged every quarter how you are executing. Are you ready with that kind of maturity or not? So these are some of the questions. I think the last one, which is process being ready, that's where CFOs play a big role, and that means that you have a solid finance team, Also solid legal and company secretarial team. Right, these two teams are absolutely, must to build before IPO, because what you take on is a lot more scrutiny, lot more governance, lot more regulations that you will have to comply on, SEBI, LODR, etc. So, then you set up strong finance team like reporting, controllership, uh, uh, planning, budgeting, all of that, and you obviously set up a strong board, because SEBI rules requires us to have at least one third independent directors. So, and directors will also expect finance team and secretarial team to be up to a standard where they can guide the organization through them, right? And then of course, you should have ideally big four auditors, not necessary, but I advise big four auditors because they bring different level of rigor and scrutiny in your numbers. So these three are must, and then you start behaving like a listed company even before you are listed, which means you have quarterly board meetings, you have the independent board members coming on board early enough, and they ask you right questions, and you really put those disciplines and governance structure in place. And then of course you can start working on preparing the DRHP, which is very intense process of 500-page document, 600-page document. So, but anyway, there are experts in terms of lawyers and bankers who will advise you. So I think what finance CFOs need to do is to build strong finance team, quarterly reporting processes, board governance, and then ability to track the performance through very clearly defined measurable matrices that are auditable. I'll pause here. I think this is my third bit of readiness advice to the team.
Quick question. How long before the actual IPO would you start doing the quarterly board meetings and kind of start acting like an IPO company, a public company?
At least a year before, if not 2 years. Like in Vodafone, we used to do it any which way, even when we are not formally declared that we are going for an IPO, because it just brings that level of maturity in the company, and it really helps, not just for an IPO, but generally improve the compliance culture, generally improve the performance culture. So in Vodafone, we started doing it much before, maybe 2-3 years before IPO. But even if you do 1 year before, you have a board in place and you have quarterly reporting and board presentation and review, that should be good enough for a startup company, right? But minimum 1 year.
You said something that was one could put under a contradictory or a um, bucket where it's not a general perception, where you said ability to experiment goes down dramatically as a public company. As a startup, especially as a technology company, not necessarily a startup but more of a scale up, but as a technology company, one would think that you would continue to innovate and continue to remain at the forefront of your industry, right? If experimentation or the ability to experiment goes down as a public company, how should one think about putting a certain dollar behind certain experiments that can enable you to be at the forefront of those technology advancements? Like let's say AI, for example. Many of the companies, whether it's software or B2C internet companies, they are public companies today. If they have to invest, let's say 10 million, 20 million USD behind a certain effort, and that is going to be seen quite unfavorably by the public market investors, how should they juggle between those two?
No, actually, I mean it. It's a fact that markets will expect you to deliver consistent performance. In fact, one of the ability that you need to create is to be able to not surprise the market negatively, if or rather surprise the market positively if you can. What basically it means that if you even if you don't give the guidance, market will expect you to perform at a certain trajectory, and therefore if you venture out in a completely different direction, and that is funded from your current P&L, which you have not indicated to market may not digest it, at least in the short term. It may take a couple of years or 3 years to recover from there. It's a different thing how good investor communication you do. But the fact is, not everybody has same risk appetite in the public market. Right? There are different investor groups who invest for different purposes and different time horizons. So versus a private company, right, where let's say if you have, even if you have 5 6 investors on the cap table, you'll be able to explain them what you're experimenting, why you're experimenting, and how it adds to your core flywheel, and how does it value help in the value creation for shareholder. So your ability to experiment suddenly goes down. But I don't intend to say that you don't promote innovation, right? Because in the tech company, innovation is integral to business model, and therefore, the way to do it is you keep some headroom in your profits, and you fund the innovation from your profits, because then market is happy to say, okay, this company is delivering profit and yet able to fire a new flywheel from its own internal accruals. It's an ideal situation, but it's difficult to achieve. Okay, so if you are some, like, let's say if a company which has a track record of so many years, let's say Infosys or TCS, if they go into some kind of new business verticals, I think market will digest easily because they have long track record of performance. But a newly built tech company entering into a market and doing a complete U-turn on its strategy or business direction, market will not digest it. Is my sense. It will be a lot of hard task to explain it to market. So better you remain private. One should have very clear articulation of why do you want to go for IPO and what time. There is no necessary thing about IPO. If you are getting capital at your terms and somebody who is willing to back you up, even in the private stage, why do you want to do an IPO? Why do you want to rush into it? I will rather say that let these initiatives develop and mature and stabilize, and then of course you have built a fantastic company which is profitable. Then of course next stage would be to go public.
Makes a lot of sense. Um, how critical is the role of leadership, especially of a CFO, in steering a company towards an IPO? Can you share any insights on maybe building and guiding a team through this whole IPO process?
No, in fact, CFO is the pivot, right, who plays a critical role in the whole process part of it. Right, I said three readiness: market readiness, which is not in your control. The business readiness is something which CEO has to steer. The business leadership has to steer. In fact, I would rather say that CFO should take all the burden of IPO, such that business teams are not distracted from what they need to build and perform on them, on the business part of it. IPO can be actually a big distraction. It can actually disrupt your journey if too much business bandwidth or leadership bandwidth goes into it. So I would say that keep a detached process and let CFO lead it, because anyway this is about getting board approval and then shareholder approval and then SEBI approval, right? All of that. Of course, business leadership plays important role in narrating the strategy and the equity story. That comes from the CEO himself. It has to, because that's what you are telling investors about how great this business is. So that comes from the CEO, but rest of it is more a compliance process, and CFO can lead into that process. Let business not get defocused while you're going for this very intense and at least 12 to 18 month process of regulatory governance, talking to markets, etc. And I think CFO plays very critical role there, but rest of the leadership can focus on the business.
Makes a lot of sense. As I think about a company becoming public one day and then trading on the bourses, it's only human for the employees to start tracking the share price on a day-to-day basis, right? And it's not uncommon for the macro to change and then those stock prices across all the companies, not just one particular company, to move, maybe move down 10%, 20%, even 30% over a matter of just a quick few weeks, right? How should a CFO think about managing that kind of morale impacting event um, across the company? Because people may just say, hey, maybe my share was worth 100 rupees yesterday, now it's worth 70 rupees or 60 rupees, and I'm just all of a sudden poorer by 30%, 40%. What a CFO should do in those kind of circumstances?
Yeah, no, that's a very right question, and it really happens, right? It is something that you will face, and those are the perils of being listed. Um, but I think before that, before you are listed, right, you start engaging with the employees, where you show, where you make them part of the value creation story, right? Because what you're taking to market is the business, and business is successful because of its employees, right? So how they are part of the value creation, how they see the big picture, and how they're part of the overall getting public, starts much before you are listed. Uh, I generally tell, at least to the management team, I tell that we make a mistake in thinking that IP an exit event. It is not an exit event. It is actually an entry event. You're entering into a market where different sets of investors will come and judge you, and they have so there could be foreign institutions, there could be sovereign funds, there could be domestic mutual funds, insurance companies, HNI, right? Diverse set of investors, and everyone had different objectives. Some people have short-term objectives, some people have long-term objectives, different criteria of judging your performance. So it's very complex. So you're entering into that complex environment. The only safest bet is you continue to perform well, right? Which means that everyone should focus on what they were focusing on even when they were private, right? Whether you're private or public, it is all about winning the customer, growing the revenue profitably, and then delivering the return on equity, right? If you focus on these three as you were doing even before getting listed, you continue to focus and execute well on those parameters, market will reward you. In short term, it might so happen that you have a headwind or some pressure on the stock, but it'll bounce back. And I learned it from Falguni, right? She used to say that in short term, stock market is like a voting machine, but in the long run, it is like a weighing machine, right? So if your performance is solid and the business is solid, your customers love you, sooner or later your stock will come back to where it should be, and it will reward to the employees and to the shareholders. And I think this is a constant uh, teaching, mentoring that she used to do, I used to do. Despite that, there will be some young employees who will get nervous about the stock movement. You can't avoid it, but of course, you can be a little open inside the company to talk about what could be happening in the market. But again, you also go through a very stringent rule on insider trading. So once you're listed, the rules on prevention of insider trading will apply, and employees are not supposed to talk about the information, or not use an information and use it for trading, right? So you have to also do a lot of internal trading, safeguarding, compliance orientation to employees, uh, and then I think it takes effort of 6 months before and 6 months after, and after that it stabilizes. My sense, employees then
Makes
start
sense.
behaving like how they should focus on normal day-to-day business and not look at the stock price.
So communication, education, and focus is the
Yes.
key.
Yeah.
Makes sense. How did you develop the muscle for public market investor relations? Because I'm sure as a private company CFO, you don't have to just deal with any of that, right? There are a very limited set of investors that you have to discuss sort of your vision and sort of your quarterly and monthly performance and so on. But public market investor relations is quite different. Number one, did you enjoy it? Number two, how did you develop that muscle?
No, of course, it is very important skill that CFO needs to add to his experience. And see, I used to talk to investors even before company was listed, the private equity investors, and we had investors of repute like Fidelity, uh, who are both in private market and public market. So when you interact with them, they will anyway ask you tough questions, even when you're private, right, on your performance. So in that sense, there was some continuity. But having said that, it is definitely a much wider set of investor pool that you start attracting when you're public. And initially, I thought, it's about IPO roadshows, and we did almost 100 meetings and met 300 investors. That really helped, right? We had a solid demand on Nykaa IPO. But soon I realized that, that is only for getting the IPO subscribed, right? But people who have put in money for in the IPO, right? They should continue to remain invested for longer tenure, right? Which means that your investor relations is a continuous job. It's not a one-time job. And therefore, every quarter after the results, I used to dedicate 15 days to meet lead investors and analysts, right, who will track your stock without fail, right? It was like more of a routine that every result announcement, next 15 days, meet at least 30, 40, 50 investors and analysts. And then, of course, over time, you will see a consistency in how the research reports are talking about your stock, how your investors are seeing you in terms of your performance. I think it is also a specialist job in the end. So, we also realize that CFO needs to also help the company in the performance and in running day-to-day business. So we then hired a senior IA investor relations specialist reporting to CFO, who would then also pick up the sentiment. Sometimes in the formal engagement with CFO and CEO, investors may not express the sentiment or undercurrent that they have in their mind. But the IR specialist would be able to informally collect those sentiments and relay it back to the company management so that they can make course correction, right? So it's a two-way process. You communicate to investors, but also take their feedback and sentiments and see where you need to course correct. But of course, you don't need to change your core direction and business model. But if there's any communication gap, you need to quickly wipe it out. So it's interesting, but it is also too much on the plate once you are listed. So therefore, my advice would be hire a IR specialist to support you.
Makes sense. Based on your experiences, what are some common misconceptions or overlooked aspects in the IPO process?
For the one which I said, right, many people think IPO is about making money or it's an exit event. It is not. It is an entry event. In fact, uh, being public means you are being scrutinized even more, and not only different investor group but also the regulator, uh, also press and media and everybody, right? So you're in limelight. So if you think that IPO is about making money and exiting from the scene, that's not what it is. It is about reaching to a particular level of maturity, both as a business model and as a governance internally. Then you hit public market, which means you're raising money from new set of investors and you're accountable to them, right? So you need to deliver on their expectation quarter and quarter, at least. Okay, one or two quarter may go bad, but then, let's say people, there are many investors who commit 3 year 5 year with you, right? So they will give you that much time, but you need to meet their expectations so that they remain invested. Otherwise, we have seen that companies destroy value after being listed. Some companies even pull back and get delisted for that reason, etc., etc. So it's a lot more coming on your plate if you're going there.
Makes sense. What advice would you give to companies aspiring to go public in the near future?
I think you should have number one. You should have be very clear. Why do you want to do an IPO? Is it for capital? Is it for building a public profile and attracting talent and brand partners? Or is it for, let's say, getting a positive performance pressure through the markets? or anything else, right? For example, sometimes companies may, like in Vodafone, we thought we are seen as a foreign company. If we are listed in India, we'll be seen more as an Indian company, right? So there could be different reasons of why do you want to do an IPO. Please think about it. It's not just that everyone is doing IPO, so we should also do. It's not a cakewalk. Certainly not. The second thing is start building finance team muscles much before the IPO event itself. In fact, in my view, one should think of CFO's role uh, as somebody who can help in creating value, uh, not just unlock value, right? So you should have a strong controllership. You should have a strong CFO early enough, even at the at the stage of Series A, Series B. Uh, Hire a matured CFO who sees a vision of scaling the company with you shoulder to shoulder and then taking it public, rather than hiring a CFO just before going public, because by then a lot of things would have shaped up where you need a cleanup. So why to land up into that situation, right? So ideally, hire a CFO early, and CFO should build a strong finance team. In fact, sometimes I wonder that why people, let's say if they have something to invest, they will hire a techie rather than a finance guy. Always that will be the choice. Now, of course, you should hire tech team and business team, but also build strong finance team. They only help you create value. Of course, they will also help you unlock value at some stage. So those are two advices. Have clear vision for why should be an IPO, and secondly, invest into finance team early enough.
Is there a particular quality or a milestone that the company should hit, or a quality that the company should have to understand that, okay, now is the right time for us to hire a CFO? You said you refer to Series A, Series B. Many companies do it after only Series C, or once they reach a growth stage. When is there some metric
See,
or
unless
any specific
yeah,
quality?
unless you have a finance domain expertise as co-founder, I would say you hire a CFO even before you do your first fundraise, right? Because they help you build the company and create the value from beginning. Even during the fundraise, I've seen that CFOs play that role of wearing that negotiation hat and negotiating right uh, shareholder agreement and the clauses under it, right? Sometimes founders end up giving too much uh, on the rights because they don't understand these aspects of governance. But if there was a strong CFO on the side, that person will take care of it. Uh, I've also seen that people do bad negotiation during fundraisers, uh, which again it may be more anxiety to have sufficient cash and close the fundraise. But again, CFO can play a role of balancing it out, taking care of future interests as well. These are strategic aspects. So I would say have a strong CFO on your side from day one.